Are you looking for how to start investing in Canada, but you're not sure how to get started? With all the different options, it can get really overwhelming to figure out how to begin investing in Canada. No matter what level of investor you are, you could always learn a little bit more. I've worked for over a decade in the finance industry in Canada, also as a financial advisor, and I'm constantly learning new things about investing. This video will be a quick intro on how to start investing in Canada, and it's a video that I wish that I had watched before I started investing. Hey, what's going on? It's Chris here from Wealth Awesome. Stick around until the end of the video and I'll go over all the mistakes I made when I first started investing and what I invest in today. Before we get started, here are two simple rules for how much to save and invest. The first rule you can follow is called the 50-30-20 rule. That means you should allocate 50% of your budget for essentials like food, shelter, and transportation, 30% for discretionary spending, and at least 20% of your money should be saved and invested. The second rule is the pre-retirement multiple. One school of thought is that you should save 1 times your pre-retirement income by age 30, 3 times the amount by age 40, and 7 times by the age of 55. For instance, if you think you need $70,000 of income during retirement, you'll need to save $70,000 by the time you turn 30 and $210,000 by the time you turn 40, and so on. The first way to start investing in Canada is by using discount brokerages or trading platforms. And this is my favorite way to invest. The investment knowledge needed though is medium to high, and the time commitment can be high as well. The fees are very low to none. Discount brokers allow you to trade bonds, stocks, ETFs, and a few other types of investments all online. They are not acting as a middleman that buys or sells stocks for you. Discount brokerages present one of the most ideal methods to begin investing. They lower the barrier to entry into the world of stock market investing for the average Canadian investor. The decision to choose between a full-time stockbroker and a discount broker can depend on a few different factors. Discount brokers facilitate stock market trading, but they don't offer direct investment advice. Discount brokerage accounts are usually available as online platforms that essentially provide investors with a self-service option. They charge fees, but their fees are very low compared to that of traditional stockbrokers or bank advisors. Since you use little or no help from them to make investment decisions, there's really hardly any labor costs that you'll have to pay for. Typically, investors who develop more of an understanding of the markets and don't need to in any investment advice should choose discount brokers. The pros or positives of using discount brokerages: you can get free ETF purchases and even free commission stock trades as well now. It's simple to use their platforms, and they do not have a vested interest in selling you particular stocks or other securities. A downside or cons of using discount brokerages is the biggest one: there's no guidance for you to refer to, so beginner investors might struggle with this. And hidden fees can exist with some of these discount brokers. They usually offer low commission rates, but they can charge extra for services like issuing stock certificates or foreign stock purchases. Another negative is there's no face-to-face interaction, which can be hard for some investors who require that in case they run into issues. They like to have someone in person they could talk to. You could get in touch with online brokerages usually through phone or online, but not really in person. My top 2 picks for trading platforms is Questrade and Wealthsimple. Wealthsimple actually just came out with the desktop version, and if you only trade Canadian stocks or ETFs, I think they're the best pick right now because all their stocks and ETF trades are commission free. So if you're interested, there's a $10 sign-up bonus in the description below. The next way that you can start investing in Canada is using a robo-advisor. The investment knowledge you need is just a little bit, the time commitment is extremely low, and the fees are relatively low as well. Robo-advisors are investing platforms that design and manage your investment portfolio for you. It's a hands-off approach to investing in Canada. How it works is robo-advisors select investments or investment classes and create a portfolio for you based on metrics after tallying the risk tolerance that you predefine to them in a questionnaire. They then build a portfolio based on your investment goals and automatically rebalance the portfolio to make sure your investment goals and risk tolerance are aligned with it. What they buy is a basket of ETFs for you based on your investment goals and risk tolerance. They determine everything by conducting a questionnaire to help them understand what type of portfolio suits your needs. Since Robo-advisors operate solely online and trade low-cost ETFs, you can expect lower fees for their service than, say, a traditional bank. If you want to get in touch with them, you can contact them usually via email, chat, or phone. Many of them even offer additional features like tax loss harvesting during tax seasons. And the pros of using a robo-advisor is it has relatively low fees, high quality and low cost ETF portfolios. It has access to human advisors. It's simple to use, and you don't have to worry about rebalancing it. It'll automatically do it for you. Many robo-advisors also offer things like tax loss harvesting that I mentioned. And the downsides of them, as I mentioned before, there's no face-to-face interaction, so you lose that human touch, which is why they call it robo, I guess. And it's also higher fees than discount brokers that I mentioned in the first section. Robo-advisors can often be the best option though for first-time investors, as they are building an understanding of investing and constructing portfolios based on financial goals. Robo-advisors provide you with financial advice and hands-off portfolio management based on your preferences. My top two picks, the first one is Quest Wealth, which has the lowest fees for a robo-advisor in Canada. You're looking at about 0.2% per year to manage it, which is super low. I consider Wealthsimple as also another great overall robo-advisor platform in Canada for its wide product selection and customer service. I included some special offers in the description below. The third way you could start investing in Canada, which is I think what probably most Canadians still do, is by investing with Big Five banks or financial advisors inside of those banks. The Big Five is a term used to describe five of the largest banks in Canada. I'm sure you've heard of them: RBC, Bank of Montreal, CIBC, Scotiabank, and TD. When it comes to investing in Canada, traditional brick and mortar banks are usually the first option for most Canadians. I worked briefly as a financial advisor at a Big Five bank, and I want to stress that most financial advisors are good and decent, hardworking people, but the harsh reality is that their paycheck is often based on how many bank-created products they can sell to you. It all comes down to the bottom line, and that is their business model. A financial advisor's fiduciary duty to provide sound and unbiased advice to you can be clouded by the incentive systems set up by the banks. Also, the investment products offered by banks are usually its mutual funds, which contain some of the highest fees in the world. For these reasons, it's my opinion that most investors are better off either doing their own research and using discount brokerages or robo-advisors if they need more guidance and are still beginning. So I wouldn't recommend this for Canadians. The next way you can start investing is with high interest savings accounts. While technically investing in a savings account isn't investing, high interest savings accounts offer you the opportunity to park your funds in savings accounts to earn a certain higher percentage return. If you need to make a purchase in the short term, say 2 years or less, a high interest savings account is the ideal place to park your money, as there is virtually no chance of losing money, as it's all guaranteed by CDIC insurance. Canadians park their capital in savings accounts and rely on the interest rates to earn returns on their money. However, traditional savings accounts are not the ideal place to park your funds because they got super low rates. So a place like RBC or TD at a savings account, you're probably earning like 0.1, maybe 0.2% on your savings, which is really low. But Canadians resort to using savings account because they entail zero risk to their capital. The rate of return from traditional accounts, however, usually can't keep up with the rate of inflation since the interest rates are so low. Whereas on the other hand, high interest savings accounts are both safe and secure investment avenues that involve minimal risk to your capital. Both of them also help to make sure that your savings don't depreciate over time due to the inflation. And I personally use EQ Bank. Right now they have a 1.5% interest rate, which is their everyday rate that you always get for now. It's not like a promo rate, so you can check out the description below. I put a link to that. Common beginner mistakes when investing. There's no better way to avoid making mistakes than by learning from the mistakes others have already made. And I know I've made a lot of them. In this section on my guide to start investing in Canada, here I'll discuss some of the most frequent mistakes beginner investors make that you need to be aware of. I think the first mistake is not understanding what you're investing in. Whether you're investing in an asset such as bond or stocks or ETFs or real estate or Bitcoin or whatever you want to invest in, it's crucial to understand how it works. Stock market investors buying the shares of a company should not simply treat the shares as stocks. According to Buffett, understanding how the company works helps you make better judgment calls about your stock position. Avoid investing in companies or ETFs that you don't at least have a basic understanding of. I saw this a lot during the first Bitcoin crash a couple years ago. There were so many people that were investing in it that had no idea what it actually did. I'm not against any type of asset. As long as you do your research and are aware of the risks, then by all means, if you could accept that risk, go ahead and invest in it. A second big mistake that I see a lot of investors make is the danger of impatience. Slow and steady wins the race. I'm sure you've heard this many times. The phrase applies to a lot of aspects in life, and it's true in the world of investing as well. A disciplined, slow, and steady approach can help investors go a lot further than an impatient one where you just want to double your money. Many investors make the mistakes of making risky moves without gauging the situation. They expect their portfolios to do more than what they're designed to do, and that can be disastrous for them. Keeping realistic expectations can help you make the most of your investment career. A third big mistake is failing to diversify. Diversification can be an investor's best friend. While you might see some professional investors make substantial returns by investing with very few stocks, beginners probably shouldn't attempt to do this. Diversification with ETFs open up a world of hundreds or thousands of stocks to diversify in across different industries and countries. And as a rule of thumb, I would say try not to invest more than 5 to 10% of your total income into one stock. The fourth big mistake that I see is too much investment turnover trading. Jumping in and out of positions as investors kills your chances sometimes of making significant returns on your capital. The transaction costs of changing your positions so frequently can eat up a lot of your returns. You also have the opportunity cost of missing out on potential long-term gains. Overall, holding cash as a strategy isn't a great one because on average, the stock market is supposed to increase over time, which is why trying to time the market can be a very difficult thing, especially as a beginner investor. So just like Rome wasn't built in a day, I know that understanding and learning how to start investing can't happen overnight. It's a lifelong process, and you'll face many challenges due to many unforeseen events, and you'll make a lot of mistakes along the way. I'm not ashamed to admit that I've made bad investments myself in the past. However, I've used those opportunities to learn and progress. It helped me learn and understand the stock market better and what types of investment works best for me. Investing is a skill that you get better at, like learning the guitar or playing hockey, though the stakes are a lot higher as it is the livelihood of you and your families. So try to start slow and just keep on learning. So I'll go over some of the mistakes I made when I first started investing. Like a lot of Canadians, I just went to the bank I was with and I just bought one of their mutual funds at like a 2% per year fee, which is insane. Luckily, I learned a lot about investing in that year or two after I graduated and was able to change it. I've tried a lot of different things. Before, I used to just invest in stocks, but recently I've shifted more towards ETFs. I just find that it's a lot less time intensive. I don't have as much time to constantly monitor stocks and move in and out positions or read financial reporting. That's kind of where I'm at now, and my total portfolio is less than 0.15% per year, so I've saved a lot on the costs. I also have real estate investment and a little bit of robo-advisor investment as well. And I wanted to share my mistakes because I wanted to show that everyone makes mistakes, even people that are in personal finance as a career, like I have been. Everyone makes dumb purchases or investments. So I'm not ashamed to admit it, and I want you to learn from it also. So since you made it this far, make sure you like and subscribe to the channel. Also, be sure to check out wealthawesome.com blog. I go over this in way more detail, and there's a lot of other topics I have about investing in both ETFs and stocks, and what are the best discount brokers and robo-advisors. I have very detailed reviews on all of those. So make sure you check it out. And as always, thanks for listening.